So what I wanted to talk about is a trade setup that is similar to 112 bear trap, and we'll just go back real quick and talk about what the regular 112 bear trap looks like, or how we set one up. And I'll use the trade that I put on earlier today as an example, and we'll kind of use that to build on, and I hope it's going to be clear as to what I'm trying to accomplish as we go through the trade. There's a lot of things running in the background, so the computer is lagging like never before. Hopefully it'll adjust and catch up. But anyways, the trade that I took today was a 112 bear trap in June 2nd expiration cycle. These trades are initiated 52 days until expiration. And the trade setup was to buy to open a 40-point wide put debit spread. And this is what the put debit spread looked like. I was buying 40-50 puts and I was selling 40-10 puts. So the distance or the difference between these two strikes is 40 points, and that makes it a 40-point wide put debit spread. The price for the put debit spread that I paid earlier today was somewhere around $10.30. This put debit spread is now trading at around $10.05. We'll go and look at the option chain, and you can see here I have, so these are my strikes. It's about 35 delta where my long leg of the put debit spread is. I chose to go 40 points wide, and this is my position. So I'm long 10, 40 50s, short 10, 40 10s, and then so the debit was $10.30 or so, and what I did was I went out and I wanted to sell two of the puts naked that were trading at the time for around the same price what my debit spread was. So debit spread was about $10.30 earlier today. And then I went out and I looked for a put that was trading for about $10.30. And 35.75 was $10.30 earlier today. So I filled, I picked up 10 of the 40, 50, 40, 10 put debit spread, and I sold 20 of the 35.75 puts naked. That produced a net credit of $10.30. Let's see if we can see what that looks like on a risk profile. And in the meantime, so I know I do get some messages from people that either don't have the account size or don't have the stomach, which is totally fine. Don't have the stomach to sell SPX puts naked. Some want to trade in investment retirement accounts that may not allow them to sell SPX puts naked. Now, I know we talked about replacement tickers such as SPY, XSP as an alternative to SPX. They are 1/10 the size of SPX contract. And also, for those that don't have portfolio margin, could use ES options or MES options. They're using span margin, and that makes it a lot more buying power friendly. In any case, for those that don't want to sell options naked, we can look for a trade setup that will somewhat resemble 112 bear trap, and I'm going to show you what I'm trying to accomplish. So we're going to work backwards a little bit. I'm going to show you what I'm trying to accomplish, and then we'll try to figure out a way how to get there. So going back to 112 bear trap, This is a put debit spread, right? We'll just use very simple numbers here. It's a 1 lot, right? So we're buying a 40-point wide put debit spread for about, let's just call it $10 here. And 112 bear trap would go out and look for a put that is trading for the same amount as what we would be paying for the put debit spread. So if we're paying $10 for the put debit spread, we would look for a put that is close to $10, and we would sell 2 of those. Now, if we don't want to sell puts naked, we are going to sell, instead of a naked put, we're going to sell a put credit spread. Now, going to where we want to end up, we're going to look for a 60 or 70 point wide, right? So I just put up a 60-point wide put credit spread as an example, and we'll look at different variations to see what those do and how it'll change the risk graph. But if we look for, let's say, a 60-point wide put credit spread, and we're going to try to sell 2 of these put credit spreads, and what we're going to collect for the put credit spreads has to equal or be more than what we are paying for the 1 put debit spread, right? So if we're paying $10 for the put debit spread and we're selling 2 of the put credit spreads for $5.65, we're collecting over $11 worth of credit for the put credit spread. We're spending $10 for the put debit spread. That leaves us with a net credit of just over $1 or $1.30 in this case. Okay, so let me just shift this thing over a little bit, and right. So this is what the risk graph is going to look like. It's similar to what a 112 bear trap looks like, but not quite, because we don't have the bear trap, or the max profit area is not as wide, because the put credit spread that we'd have to sell instead of the naked option is much closer to at the money. So the bear trap is much smaller, right? And that's the bad part. But the good part is that we no longer have unlimited risk to the downside, right? And we don't have to put up as much margin to put this trade on. Let's talk about the requirement for this trade. So we're using a 60-point wide put credit spread, and we're using a 40-point wide put debit spread. And we're collecting, right? So we have 2 put credit spreads, 1 put debit spread, and we're collecting a net credit. That means that we only have risk on one side of this risk graph, which is on the downside. So now we can try to figure out what the risk is. The risk here, we could only lose on the downside, which means that if SPX at expiration is below our long leg of the put credit spread, 37.40, this trade will produce a max loss, and the max loss is figured out by looking at the difference between these 2 spreads, between the put debit spread and the put credit spread. So we have a 40-point wide debit spread and a 60-point wide credit spread. The difference is 20 points, or $2,000. Now we have 2 put credit spreads, right, with 1 put debit spread. That means we have a max potential loss of $4,000. If S&P 500 is below 37.40 at expiration, we could lose $3,000. Well, we can lose $4,000, right? And then since we have 2 of these spreads, this will go to $8,000. So the max potential loss here, if we do nothing and just let it expire, is at $8,000 below 37.40, minus the small credit that we're collecting up front that takes our loss on the downside to $7,880. So we know that if we do nothing and just let this trade play out, below 37.40 we can lose almost $8,000. Now that's not our risk that we're willing to accept in this trade. I don't think we should. We should definitely plan a stop loss here, and we can probably use something similar to what I use for a 1-1-2 bear traps, where if I'm down more than what I could potentially make inside the trap, so in this case we have a 40-point wide put debit spread, which has a max potential value of $4,000 plus the small credit that we collect up front. Let's call it $1.20 or $1.30. So we could make just over $4,125 or $130 if we are inside the trap, somewhere between the put credit spread and the put debit spread at expiration. So if this trade has max potential reward inside the trap, let's call it 41.25, right? I don't want to risk more than maybe $4,000 or $4,500 in this trade. Now the good thing here is because we have a put credit spread instead of just naked puts, right? To get to $4,100 loss, we can give this trade way more room than we would with a naked put. So you can see that S&P can go to 3,600, and this trade will show a loss of about $3,600 or $3,700, which means that at this point we still don't need to stop out. But then if we let the price, overshoot our trap, this will put us in a very difficult position from which we would have to figure out a way to raise our I would call this the left side of this risk graph above zero, and without introducing a lot more risk, I think it would be nearly impossible. So I would say that in this trade, we can probably use downside break even as a potential stop out. So if the price crosses below 37.80 in this example, this trade would probably be down about $1,600 or $1,700, and we can potentially stop out of this trade and set up a new trade. Now we can also look at probabilities for this trade, right? This is a high probability trade setup because the proposition here is, if the market goes higher from where we are right now, right, the most we could possibly make, if we're not inside the bear trap, if we're outside the bear trap, the most we can possibly make is the credit that we're collecting up front, which is in this case $130. So you can say, well, $130 with $7,870 worth of risk, this is 1.65% return on risk, right? Over 52 days. This is about a 11.5% return if we take this rate of return and annualize it. So that doesn't sound too crazy, right? A 12%, 11.5% return on risk. But at the same time, if we were to look at what is the implied probability of profit here, right? What is the implied probability of SPX expiring somewhere above our downside break even, which is at 37.80, and the implied probability of profit for this trade is about 90%. So you could expect, if you put a large number of these trades on, you should expect to win or to land SPX somewhere inside or somewhere at 37.80 or higher, in this case, about 90 out of 100 times. So this is a very high probability. This is why we're not getting, the sexy 40, 50, 60% return on risk in this trade, even though if you think about this, right, there are going to be trades that are going to expire outside of the bear trap to the upside. and there are going to be a number of trades that are going to expire inside of the bear trap, right? So if we get one or two of these trades expire inside of the bear trap, and assuming that we're recycling the same, $8,000 that is required to put this trade on, if we just catch one of these trades inside the trap for, let's just call it a $4,100 profit with about $8,000 worth of risk, that's a 50% return on your risk. Now you can afford to take a couple of stop outs down $1,600, $1,800 or so. But if you catch a few of these trades inside the trap, they're going to more than cover those trades that caused losses due to stop outs. So that's why I think that this trade makes sense. It doesn't take up as much buying power as a naked put, but we are placing, and you can see here, the short option of the put credit spread is at 3,800, right? So this is a 3,800, 3,740 put credit spread. Now, if we were to use a short option naked, we would place that put at 3,575, so almost, just over 200 points lower. So the size or the length or the width of this bear trap would be much wider, which will give us a higher probability of catching price inside the trap, but we would have to put up a lot more margin than $8,000 to put this trade on. I do believe that to sell two of the 3,575s, we would need about $28,000 versus if we were to set up a bear trap using a put credit spread, we're putting the put credit spread much closer at the money, right? Almost halfway closer. So we're between 4,000 and 3,600. So we're at 3,800, almost halfway closer to at the money. But your margin goes way down, right? It goes from 28,000 to only about 8,000. So that's the benefit. That's the good part, right? I always say that, there's always the good and the bad. So the good is that you don't have to put up as much margin. The bad is that your bear trap is not as wide, which means that there's a higher probability of price overshooting the trap on the way down. But we just talked about, and this is something I also wanted to point out, is that we were looking at a potential stop on the break below downside break even, which was 3,780, I think it was. So at 3,780, we were showing a loss of about $1,600 or $1,700 using the put credit spread, right? So down here at 3,780, we're showing a loss of about $1,650 or so. Now, if we look at using the naked puts at 3,780, man, my computer is lagging so much, so I appreciate your patience, guys. Just give it a second, and hopefully it'll catch up. At 3,780, using the naked puts instead of the put credit spread, this is a loss of about $8,200 or $8,300, maybe a little less. Let's call it $8,000, right? So it's showing about at 3,775 using the standard 112 bear trap. This trade would be down about $7,500 using the put credit spread at 3,775. This trade would only be down about $1,600. So we definitely take a lot less heat on the downside. We would, and that's the good part, but the bad part is that we would have to stop out way sooner using the put credit spread instead of the out of the money short puts naked. So there's definitely some positives and some negatives. You would definitely want to find a balance to see what works best for you. But I think this is a very viable solution if you didn't want to trade a standard 112 selling out of the money puts naked on SPX. or if you didn't want to use any other instrument, and using SPX but a defined risk strategy, you get the same tax benefits, so you don't really have to worry about anything other than price going outside of your bear trap. You would have to decide, but you also have to have a solid plan for your trade, right? Nobody wants to take a $1,600 loss, but then, when you get there and you say, well, it's going to come back and the price could continue to go lower, and then it could go up a little bit, and it could go sideways. But once you're outside of the trap on the downside, if you don't get a pretty quick move back inside the trap, your theta, even though the Thinkorswim software will show you that down here at 3709, which is right here. Oh no, it's actually, it's showing a -5 theta. So once you're outside the trap on the downside, the theta is no longer working in your favor, right? You have this small debit spreads, and I say small, when we compare this to the two of the put credit spreads, this put debit spread is really not doing a whole lot for you, but the put credit spread that is now in the money, right? It's really going to start to work against you. So that's why I think that having a stop is very important here, because once you get outside and you could convince yourself that at some point it's going to come back, and it doesn't have to. It may not come back, and volatility may fall. And if volatility does fall, this T+0 line is actually going to get crushed. So once you're outside the trap on the downside, I think that using a stop is very important. We could also look at. So I used 40-point wide put debit spread, and I used a 40-point wide put debit spread and a 60-point wide. I'm just going to close this put credit spread, just as an example. It doesn't have to be. So what I did was I used the same exact strikes for the put debit spread that I used for my 112 bear trap that I put on earlier today. And that's why we're using that here in this example. But it doesn't have to be 40-point wide. You can use it a 30-point wide. You can go 50-point wide. It all depends on what your outlook is. So this is 52 days until expiration. You can see that setting up this trade for a net credit of about $1.20, this will start this trade off with a positive, just slight positive delta, positive theta, and negative vega. Now, if we're trading, at +3 ATR on the S&P, and you think that, there's a very good chance that we are going to revert back to the mean, and you don't want to initiate a positive delta position at such an extended level, right? You can make your put debit spread a little bit wider. And notice that, we go a little wider. Now our debit goes from 10 and change to 12 and change, and 12 and a half. Our delta was plus 1.3. Now it's only 0.25, right? So the wider the put debit spread, the less of a credit we're collecting, but your directional exposure changes as well, right? So actually here we are paying a net debit of about $1.10. So we start off with a small debit. We get a wider put debit spread, which means that inside the trap, we have a potential, instead of making about $4,000, now we can make almost $5,000, right? Because we have a 50-point wide put debit spread minus the small debit that we're paying to put this trade on. So just shy of $5,000 profit inside the trap. So we increased our potential reward inside the trap at the expense of, instead of collecting a credit, we're actually paying a small debit. And we have less positive delta to start, which means that if the market starts to pull back, wherever the mean may be, maybe it's at 40.75, right? If we revert back to the mean, technically, right, if this happens in one day, it's not going to play in your favor. But if this happens over the course of 2 or 3 weeks, the value of the put debit spread is going to increase, the value of the put credit spread is going to decrease. Technically, we can see that. Let's go forward from today to, let's call it 3 weeks from now, right? So 3 weeks from now, assuming we pull somewhere towards the bear trap, right? You can see that the unrealized gain in this trade is somewhere around, at 40 or so. The unrealized gain in this trade is about $450. And that's due to decay in the value of the put credit spread and the appreciation in the value of the put debit spread. Right? So based on your directional outlook, you can choose the widths of the debit spread. You can also change the width of the put credit spread to control how much you have at risk on the downside. Right? You can say, and this is probably not the right way to go about it, but you can say, what if I only have a $5,000 account? This trade will require, a $7,000 margin. I can't do it. Okay. So you can go, maybe instead of doing a 50-point wide put debit spread, you go 30-point wide put debit spread, right? So 40, 30. Right, so I don't know. Did I say 20-point wide or 30? Well, we can go. So you get 20-point wide put debit spread, and then you can use let's see if you can use maybe a 30-point wide put credit spread, and you're using two of them. Right, so you're still collecting a credit up front, small credit, $85, and on the downside, the margin goes from 7,000 or 8,000, whatever we were, to under 4,000. Right, so just changing the widths of the spreads, you can control how much you collect up front, how much you have at risk on the downside, which is the positive. And the negative is that if you make the put credit spread smaller, your downside break-even moves closer to at the money, which in turn will decrease the probability of profit, or it will increase the probability of price going and pushing you to your stop out, or a level where you would have to pull the trigger and get out of the trade. Right? So there's always that good and the bad balance. So the idea, in a nutshell, right? If you just tuned in today, just now, I would say that if you don't want to do a 1-1-2 bear trap the way we normally do it, you can say, all right, I'm going to use the same put debit spread, but instead of selling out of the money puts naked, you can find a put credit spread that is slightly wider than the put debit spread. You're going to use also 2 put credit spreads for every 1 put debit spread. And the total credit that you collect has to slightly exceed the debit that you're paying for the put debit spread. Right? So in this example here, don't mind the widths of the strikes here, but in this example here, if we're paying $5 and let's call this $5.25 for the put debit spread, and we are collecting 305, right? So 305 times 2 is 610. So we're paying $5.25 and we're collecting 610 for a net credit, right? 610 minus 5.25, we collect 85 cents or $85 per 1 bear trap. Right, so this is not a 1-1-2 bear trap. It's a 1-1-2-2, whatever you want to call it. So that's the idea, right? The widths of the spreads are going to control your initial delta, your directional exposure. It will control how much credit you collect up front. If you wanted to, let's say if we're trading at -2 ATR and you think that there's a very good chance that The market may consolidate, but not go much lower because we're already kind of oversold. And there's a very good chance that the market's going to go higher. You can, number one, you can place your put credit spread closer to at the money, and this will increase your overall credit up front. You can also make your put debit spread narrower. So 40-50, 40-30, what if we go up 10 points? Right, so from 40-30, we go up to 40-40. All right, smaller debit makes it a larger credit. So if, let's say, in this example here, we're collecting $6 for the two put credit spreads, but we're only paying $2.70 for the put debit spread. Our credit up front goes from 85 cents in the previous example to $3.30 or $330. But in exchange, right, we get a lot more delta to start with. This will take a little bit more margin because our put credit spreads are wider than our put debit spreads, right? So that's the idea. So you also, before you put this trade on, you kind of want to look at a chart, look at whatever it is that you use to dictate your directional bias, right? If you're bullish, then you have to set up a trade that is bullish to start, right? You have more delta to start with. If you're neutral, then you can, start off with a slight positive delta. And if you think that we're overextended to the upside, if the market is way overbought, there's a very good chance that we're going to pull into the trap. You could start this trade off with a net negative delta. Instead of collecting a credit up front, you could pay a debit, and then you're playing for the price to revert back to the mean. Hopefully, the mean is somewhere inside of the bear trap. But then again, remember that this trade has 52 days until expiration. So if you're playing for a reversion to the mean, but there's 52 days, we could pull back right to the mean, go inside the trap, and then potentially go back outside the trap. So you want to think about what it is that you're going to do as far as, if you're paying a debit to start, let me show you what that looks like. This is going to kind of help you maybe visually understand. So let's say, the market is now overextended and we're thinking that the market is going to pull back. We're using a 30-point wide put debit spread, and we're using 2 of the 30-point wide put credit spreads, right? So we start off, we're collecting $6, right? 3 times 2 is 6. That's what we're taking in. We're paying out $7.70. That leaves us with a net debit of $1.70. That's our risk on the upside. We start off with negative delta, minus 0.38. Our margin is only about $31.70, so we have $3,000 worth of risk plus the $170 that we're paying for it. So our max risk on the downside is $31.70. Now, if the market goes down, up, and down again, and up, and then eventually up, and it's running away, we kind of don't want to fall asleep here, because in a regular 1-1-2 bear trap, remember, we took in a credit up front. We don't care if the market runs away to the upside. We don't have to do anything, because if the price is outside the bear trap, we'll keep the credit. But here, we're not starting off with a credit. We're starting off with a debit. So if we let the price run away from the bear trap and stay there, there's a chance that we may end up losing the $170 that we're paying to put this trade on. So what that means is that at some point, we would need to figure out a way to bring in at least $1.70 credit from somewhere, right? We can shrink the size of this spread. We can possibly widen our put credit spread. We need to collect an additional $170 to eliminate upside risk. So this is not a set and forget type of trade like a 1-1-2 bear trap is. Right? This is a little bit more hands-on. Our stop is much closer. We also have to deal with potential loss on the upside. But I think that as long as the market is not falling out of bed, as long as we're not moving up or down 3 standard deviations from day to day, I think this is a fairly easy trade to manage. And I think overall, I think that over a long period of time, right? If you do this trade once, twice, 3 times, it may seem like, yeah, this trade doesn't make a lot of money, right? And it's boring and whatever. I think that over time, if you catch the price inside the trap at expiration once or twice, it's going to make this trade a lot more exciting. And I think that you will be surprised how often you can reach 10, 15% return on risk, especially if you initiate this trade when volatility is contracting, right? Similar to what we have been seeing in the market in the last couple of weeks. You can draw up your trading plan for this trade and say, all right, if I'm up, 15% on risk in the first 2 weeks in this trade, I'm going to cut it and maybe set a new trade, right? Or you can say, if I'm up, whatever that amount is, I'm going to take half of this trade off. Or you can say, I'm not going to touch this trade for the first at least 30 to 45 days. I'm only going to watch my stop, right? There are many ways to play this trade. If you start with a net debit, you can say, all right, I'm going to watch this trade for the first 30 days. But if we are trading outside and we're starting to get too far away from the bear trap, right? Because remember, the market could trend a lot longer than anybody could expect. So if we're now going to break out and start a new trend and trend much higher to 42, 4,300 and beyond, this trap is obviously not going to do much for you, but you also have a debit that you need to worry about. Or at least you want to recover that so that, worst case, this is a scratch and not a loss, right? So maybe you'll be able to come out slightly ahead most of the time on this trade. And then a few times when you catch the price inside the trap, I think that's going to cover all of, the small gains that are not exciting. I hope this makes sense. So that's the idea, right? The idea, I think that, and this is going to evolve and change over time. I guarantee you that, right? This is not a set in stone. This is the only way to do it. I guarantee you that there are going to be people in our group that are going to come up with maybe better strike selection, better management techniques, right? Which is totally fine. And that is the goal, is for you to start thinking a little bit. Find something that works for you, right? But just in general, the idea here is when I do the 1-1-2 bear traps, you can use the same put debit spread, but instead of selling naked options, you can replace that with 2 put credit spreads, figure out the width, right? Depending on how much buying power you want to use up or how much margin you want to put behind this idea. So find a put credit spread using 2 put credit spreads that combined will cover the cost of your debit spread. And that is going to resemble a 1-1-2 bear trap. And I think that we have covered pretty much everything that I can think of. I'm pretty sure that I left a bunch of stuff out. So if you have any questions, feel free. You probably could unmute yourself if you wanted to. If not, there's a chat in this channel, so you can use that. We'll hang around for the next 20 minutes. If you guys have any questions, I would be more than glad to answer.